So gold prices just took a massive nosedive. And if you're kind of scratching your head wondering what on earth is going on, well, you've come to the right place. We are going to break down exactly why gold crashed, and more importantly, what it could mean for you.
Okay, let's just jump right in with the number that's got everyone talking. Gold prices have plunged a whopping 24% on the MCX exchange just since the beginning of the year. And to put that into perspective for you, that is a huge move for an asset that's supposed to be, a super stable store of value.
So, what is the real story behind this massive drop? Well, it's not just one thing. Think of it more like a big puzzle. And right now, we're going to put all the pieces together, from the super fast-paced world of trading all the way to the slow-moving currents of the global economy.
All right, our first piece of the puzzle is all about the markets game. This is where we see the most immediate trigger for the price crash. Pure, simple market mechanics at play. It really all kicks off with this concept called profit booking. And honestly, the name says it all. Just imagine you bought some gold, its price went way up, and now you're thinking, hey, I want to cash in on those gains. That right there is profit booking. Okay, and this is where it gets really interesting. This slide lays out what was basically a perfect storm, all in 4 simple steps. First, gold prices were flying high, right? Then a critical deadline hit on January 29th. These things called futures contracts, basically just agreements to buy or sell gold later, they all expired, and that was the trigger. Investors just rushed for the exits, all at the same time, selling like crazy to lock in those profits. This sudden flood of selling just completely overwhelmed the market, and boom, the price cratered. It was a classic domino effect.
But you see, that massive sell-off, that was just the spark. The real fire is fueled by a much bigger, much more powerful economic force. It's this fundamental tug-of-war that really dictates the price of gold day in and day out.
And this slide just illustrates that core dynamic perfectly. Just think of gold and the US dollar sitting on a seesaw. When the dollar gets stronger and goes up, investors don't really feel the need for the safety of gold as much, so its price tends to go down. But on the flip side, when the dollar is weak, investors get nervous and they rush into gold, and its price goes up.
So here's the most important takeaway here. If you want to predict where gold is going, you've got to watch the dollar. They're basically locked in this inverse dance with each other.
And here's a really fascinating subplot to this whole story. There's this sort of quiet rebellion brewing against the US dollar right now. Countries all over the world are starting to look for ways to trade directly with each other using gold, totally cutting the dollar out of the picture. Now, this is a slow-burning trend for sure, but if it really starts to gain momentum, it could completely reshape gold's role in the global economy.
So if the dollar is the driver, what's sitting in the driver's seat? Well, it really just boils down to 2 of the most powerful emotions that move any market: fear and hope.
This table just lays it all out so clearly. Whenever fear is in the air, whether it's from inflation, worries about a recession, or global conflicts, investors run for cover, and gold becomes their go-to shelter, which drives prices up. But when things are looking good, when the economy is stable and the stock market is booming, that fear kind of fades away, and so it does the demand for gold.
So the formula is actually incredibly simple. More fear in the world equals more demand for gold. And right now, let's be honest, the fear gauge is cranked up pretty high with inflation and all the global tensions. That's a big reason why gold prices have been so strong lately, right up until this recent wave of profit-taking we talked about.
All of this analysis, of course, brings us to the one big question that I'm sure is on everyone's mind, especially with prices having come down so much.
So what's the verdict? Is now the time to jump in and buy, or should you stay far, far away? Let's take a look at what the experts are suggesting.
Okay, so the general advice seems to be cautiously optimistic. This drop could definitely be a buying opportunity. But, and this is a big but, don't just jump in blind. The market is really choppy right now. And here's a key thing to remember. The price you see online is not the price you'll actually pay at a jeweler because of taxes and costs. So, the bottom line? You have to do your own homework. And remember, gold is a marathon, not a sprint. Its long-term value is what really, really counts.
And that leaves us with one final big thought to chew on. As we see countries trying to move away from the dollar, and with digital currencies on the rise, we're all left to wonder about gold's ultimate role in the future. Is it going to reemerge as the money of the future, or is it just the shiny relic of a bygone era? That is something we should all keep an eye on.